Hello and welcome back to Investor Info, where investing is made simple. You may have particular investment objectives for 2022, all of which entail producing money. However, if you're not careful, your ambitious goals for the new year may backfire spectacularly. In today's video, we'll be diving into what investing mistakes you should be avoiding in 2022. But before we begin, make sure that you hit that subscribe button and click on the bell icon so you'll get notified every time we upload a new video. You are not going to want to miss out. Let's get started. If you're like the majority of investors, you'd rather spend your leisure time with family and friends, watching football, shopping, or bringing the kids to the park. The financial markets are complicated, and there's a lot of information that might be bewildering to someone who is just trying to prepare for retirement, save for their children's college tuition, and create a nest egg. A major blunder made by do-it-yourself investors is converting investments to cash at the wrong moment and allowing fear or greed to govern their decisions. This is a marathon, and you invest across numerous market cycles, not selling at the wrong moment because of the market downturn. Make a written strategy outlining your aims and objectives, as well as the allocation of your portfolio. If you find yourself wishing to quit the markets, return to this text. Markets fluctuate in cycles, and investors who purchase into last year's huge winners may be purchasing close or at a high. Do not follow a craze and invest in a hot stock without first conducting a thorough fundamental analysis. If an asset class or securities has already seen significant increases, it was a solid idea yesterday. Don't follow the pack since you'll be chasing performance, which is a losing proposition. Many long-term investors may find that focusing on a correct asset allocation between equities and bonds, selecting funds, and hunkering down for the long run is the ideal method. Commissions will nibble away at the nest egg of eager beavers who transfer in and out of funds too frequently. Trading costs money, and the more you trade, the more money you lose in your portfolio. Purchase assets at a fair cost and keep on to them. Exchange-traded funds have reduced the cost of investing in a wide range of asset types. Rookie investors may disregard expense ratios, but hefty fees can cut into a portfolio's overall return over time. Many funds are now accessible to investors at fee ratios of 0.20% or less, which is $20 yearly for $10,000 invested. While pricing is only one element to consider when selecting a fund, it is an essential one. Individual investors, and occasionally even experts, fall into the trap of attempting to time the market, or to put it in another way, selling high and buying low. It has been demonstrated time and time again that continuously outwitting the collective knowledge of the millions of brilliant, well-informed people who trade in the market is extremely difficult, regardless of who you are. Disciplined rebalancing stops you from falling into the market timing trap. Diversification is the cornerstone of long-term financial success. Spreading investments across asset classes and into those that move in the opposite direction of stocks can help decrease portfolio risk. There is a quote about diversification from T. Michelle Jones, who is the vice president at Bryn Mawr Trust in Bryn Mawr, Pennsylvania, and it reads, quote, "Many investors think of diversification as simply owning more stocks. However, you must also consider asset allocation as well as how your investments move in relation to one another, which is known as correlation." Unquote. A varied portfolio is essential for two reasons. For starters, it can help you accumulate greater money over time. Second, it can shield you from stock market volatility. Assume that the majority of your investment is in tech companies, and then that section suffers a significant loss in 2022. You might be staring at significant losses all of a sudden. A better bet is to possess a diverse portfolio of companies from several market categories. You may also diversify your assets by adding broad market index funds or exchange-traded funds to your portfolio. That being said, you shouldn't limit yourself to a particular asset class in your portfolio. Stocks are an excellent long-term investment, but you may wish to diversify into other sectors such as real estate and cryptocurrencies. If you engage a financial advisor, it's critical that you understand how he or she is compensated. Some are compensated by the financial goods they offer, while others are fee-based, which means they receive some of these payments and charge customers a fee. Then there are fee-only advisors, who are compensated only by their customers and receive no product-based compensation. The amount you pay is significant, but so is the source. Is your advisor compensated to provide you impartial advice on how to handle your wealth prudently, or to sell you financial products? Plan on having time on your side if you want to save for retirement or your child's college fund. Don't keep an eye on your portfolio every day. According to Danielle L. Schultz, who is a certified financial planner with Haven Financial Solutions in Evanston, Illinois, you should review your statements at least quarterly. Here is a quote from Danielle. Quote, "Beginners are sometimes astonished by how much the market may fluctuate day to day and leap in and out, often at precisely the wrong periods. I urge that individuals learn how to properly examine firms." Unquote. Moving on, we don't know what the stock market will be like in 2022. Perhaps stock prices will remain stable, or perhaps we'll see the worst stock market meltdown in years. While there is no reason to believe equities will do poorly in 2022, it is always a good idea to be prepared for a market catastrophe, and having the appropriate mentality is a significant part of that. One of the greatest errors you can make as an investor is to sell off stocks in a panic when their value falls significantly. You lock in losses when you do this. However, if you sit tight and wait things out, you will generally come out unhurt. Determine how you will cope with the stress of a stock market decline in the next year. That way, if things do go bad, you won't be tempted to sell stocks at a loss right away. Now, if you're the risk-averse sort, you might be apprehensive to have a large number of equities in your portfolio. However, if you allow yourself to invest too cautiously, you may lose out on large returns over time, leaving you with less wealth. You may be concerned about stocks collapsing in 2022, or you may be unwilling to accept the dangers connected with holding digital currency. But one thing you should avoid doing in the next year is limiting yourself to safe assets such as bonds. To be sure, if you're on the verge of retiring, it is best to play it cautiously. However, if you're still a few years away from that milestone, it is a good idea to diversify and start buying stocks, even if they're only a little part of your portfolio right now. Many investors have had success with Bitcoin, so you may be considering investing in it or increasing your current holdings in 2022. This isn't always a mistake, but you shouldn't go from holding almost little Bitcoin to suddenly having it make up 50% or more of your portfolio. Though there is no such thing as a risk-free investment, Bitcoin is famously dangerous, much worse than equities. Not only can cryptocurrency values fluctuate more than stock prices, but digital currencies haven't been around as long as some of today's oldest publicly traded corporations. As a result, we have no idea how feasible Bitcoin is as a long-term investment. Start modestly if you want to add cryptocurrencies to your portfolio in the new year. Also, have a varied mix of assets other than cryptocurrencies. With the year of 2022 upon us, it's natural to begin planning an investing strategy for the coming year. Avoid these blunders to set yourself up for a successful 12 months. Keeping your money in a savings account rather than investing may appear to be a safer bet. In actuality, your money is most certainly losing real value. Savings interest rates are anticipated to be lower than the rate of inflation, which is now 4.6%. This means that your purchasing power will dwindle over time. According to a Barclays analysis that utilizes data dating back to 1899, the chance that shares exceeded cash savings was 75% over 5 years, growing to 90% over 10 years and 99.5% over 18 years. According to Money Facts, the average stocks and shares ISA has provided positive growth in 11 of the 18 tax years since they were launched in 1999. While all investments include some risk and their value might rise and decrease, they can help your wealth develop over time. If you're saving for a goal that is more than 5 years away, you should think about whether investing is the best option for you. And there you have it, folks. Now that we've discussed the common investing mistakes you should avoid in 2022, let us know in the comment section down below which one you are going to avoid. Remember to always do your research and make the most of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video.